Nothing works in perpetuity, yet we're looking for the easy way out. We're looking for the set it and forget it strategy. Everything cycles. Welcome to How to Retire on Time, a show that answers your retirement questions. We're here to move past that oversimplified advice and dive into the nitty gritty. Now, just remember this is just a show. It's not financial advice, so please do your due diligence. If you got questions, text them to 913-363-1234, and we can feature them on the show. David, what do we got today?
Hey, Mike, there are many strategies out there suggesting income, I'm assuming that's retirement income, around 8 to 9%.
Mm-hmm.
Why are advisors still talking about the 4% rule?
Yeah.
Give us a little bit of the history. Like, if you don't know, what's the 4% rule?
Yeah.
Now we've got 8 and 9% being thrown around.
This is such a good question, and I have to laugh. Not at this person, at these circumstances. All right. So, okay. Before I talk about the 4% rule,
Okay.
David, when was the best time to take part in the gold rush in San Francisco?
I guess at the, I don't know, was that 1850 something?
Well, not I don't know the dates,
the
but like
beginning?
the beginning, the middle, or the end.
I mean, yeah, you'd want to be there at the beginning, and supposedly when it's just you just stick your pan in there and
It was just
pan full of-
gold.
yeah, just gold everywhere.
Yeah. When was the best time to put money in Bitcoin?
I guess again at the very beginning when people could still mine it on their own, right, with their machines in their garage.
Yeah.
Yeah.
It's like there's this interesting trend of things really work out until they don't. Now, there's a fun saying in the industry. The financial services space is full of really pithy one-liners. Here it is. Okay, brace yourself.
Okay.
It works until it doesn't.
Yeah, that feels fairly universal. Put that anywhere.
So, and here's just a couple of examples. Equities in the 90s worked until 2000 when it didn't, and you made no money for 10 years.
Yeah.
Bond funds were miserable from 2010 on until they started working again. Okay? It works until it doesn't. Nothing works in perpetuity. Yet we're looking for the easy way out. We're looking for the set it and forget it strategy. And so right now, based on market conditions, based on current interest rates, and they're kind of going down a little bit, based on the bond market, which is the largest market that's out there, based on the AI revolution. There's a lot of things going on here, okay? There are certain investments or products that appear to almost consistently give you 8, 9, maybe even 10% annual dividends, income from contracts, income from real estate, whatever it might be.
Okay. And you say they appear to.
Yeah.
What's the next?
All markets cycle. You've got the bond market. That's going to be good. It's going to be terrible. You've got the equities market, the stock market. That's going to be good until it's not, and then it's going to be terrible. You got the real estate market, which is going to be good until it's terrible. You got your precious metal market, which is going to be good until it's not. Everything cycles. So I have no problem with someone doing these covered call ETF strategies that are paying out 8, 9% until they don't. I have no problem with the annuities fall into this category. Okay.
Okay.
Right now, and I'm not pitching any sort of product, but you might be able to put your assets, buy an annuity, and it pays you, let's say, 7, 8% income for the rest of your life, guaranteed. Who wouldn't want that kind of a deal?
Yeah.
Okay. It works until it doesn't, and even the guaranteed income for life works until it doesn't, as in like inflation erodes or taxes go up and it erodes. So there's just the backing of the insurance company goes bankrupt, and now you're dealing with the state trust fund that's supposed to help offset all of that, and that's a disaster you never want to get a part of. So it works until it doesn't. And you need to understand the latter side of it. We don't like talking about the detriments. We don't like talking about the pain, the issues. You know, if you've ever known someone that goes to therapy, which is a very healthy thing, they don't want to face the trauma that they're going to have to deal with. But if they do, on the other side, it's typically a healthier life. No one breaks their arm or has a stroke and is like, I'm really looking forward to physical therapy.
Yeah. Right.
But if they go through it, if they understand it, then they're able to have a better life on the other side. You've got to understand what's on the other side. Okay. So, all the things that are suggesting the real estate market, actually, hold on, I'm going to pull this up. Moody's, I think it was Moody's, or maybe it was Fannie Mae. There was a recent study, this was fascinating, that came out, and this is on the real estate market, that was suggesting we might be at a real estate market top.
Oh,
So the real estate market could crash. Okay, let me find it right here. I save all of this because I have to source this stuff. So it was Fannie Mae.
okay.
Fannie Mae said if we want the real estate market to be affordable again, which, by the way, affordable again is another way of saying it's reached equilibrium, as in we could be at a market top right now, and maybe it stays overpriced for a while. But what happens when there's not enough buyers and things start tipping over? For the real estate market to correct, one of three things needs to happen. Prices must go down by 38%. I would call that a crash. Okay. Or income must increase by 60%. Average household income. That's not happening anytime soon.
That sounds like a tough sell.
Or mortgage rates must go down to 4.15% or so. Must
Okay.
go down. That's the 10-year treasury has to go down. How is the 10-year treasury going to go down? Well, that means the Fed is lowering interest rates, making money really, really cheap. But even then, that's not going to happen. If you look at what happened in Europe, they were lowering interest rates and their 10-year treasury equivalent kept going up because the confidence in the treasury debt wasn't high. So they have to pay a higher interest rate, and the 10-year treasury is what affects mortgage rates, not the Federal Reserve rate. And people miss that. So you're in a really crappy situation because it's not likely that mortgage rates are really going to go down, in my opinion, like that kind of drop. Because even if the Fed drops rates, I don't think treasuries are going to go down with it as quickly because our debt's so high.
And so
So-
we would need a lot of people who are sort of banking on their equity in their home. Like imagine if your home was 30% like less valuable.
Oh my gosh, no one would want to sell.
Yeah.
But then you've got like a third of the states that are showing recession-like symptoms. I'll tell you the states. You want to hear the states?
Oh, are you
So
gonna
this is
say-
based on GDP.
Are you
so
gonna say
this-
Kansas?
Yeah, these are states where their gross domestic production, their ability to produce, is going to near recession. Recession means that the negative production of a state has gone down for 2 consecutive quarters.
Okay.
That's a recession.
Yes.
Depression's 4.
Okay.
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 So recession-like symptoms. So they could be entering into recession. Wyoming, Montana, Minnesota, Mississippi, Kansas,
Ooh.
Massachusetts, Washington, Georgia, New Hampshire, Maryland, Rhode Island, Illinois, Delaware, Virginia, Oregon, Connecticut, South Dakota, New Jersey, Maine, Iowa, West Virginia, and District of Columbia.
For some populous states.
Okay, and that list, I believe, is growing.
Yeah.
So if they're going to recession, recession's when your neighbor loses their job. Depression's when you lose your job.
Yeah.
If that's happening and they're losing their job, the real estate market starts to slow down. If the real estate market starts to slow down, will people panic? I don't know. Will people hold on? Will they be able to hold on to their properties? If they can't hold on to their properties, do they go to foreclosure? If they go to foreclosure, there's all sorts of things that could panic. If you really look back at 2008, it wasn't a financial crisis like people really thought. There's a great TED talk about this of mark-to-market accounting, which we've gotten rid of. So, you don't have to learn about that. But then the panic that ensued. It was like a little fire just blew up into this massive panic. So there's all sorts of things that could or couldn't happen that create a real estate market correction. But the reason why I bring that up is because you've got a lot of wonderful privately traded REITs, for example, or just real estate investment companies, public or private, that are paying a good dividend until they don't. It works until it doesn't.
We've come back full circle.
So you don't want to assume that anything's going to work forever.
Yeah.
You want to, in my opinion, have the flexibility to shift based on market conditions
Okay, so
and to keep an eye on all that.
does that mean that the 4% rule doesn't work forever? Is that what
Let's go back to that. Yep.
Yeah.
So the 4% rule is not really intended to be an actual rule you follow every single year. The idea was simple. If, let's say, stocks average 7 or 8% year over year, which historically they have, and the bond market averages 3-4% year over year, which historically it has, you should be able to take out 4% from your portfolio and be fine because you're taking income and there's still growth to offset inflation. It is an intentional rule of thumb to help figure out how much income you should have in retirement or you could have in retirement. Okay?
Okay.
Because the 8-9% dividend isn't inflating. It's not growing with inflation a lot of the time. So what good is 8-9% dividend or an annuity that's paying you 7-8% for life or whatever it is? Notice 7-8% guaranteed for life income. After 10 years, you've lost 25% of that buying power because of inflation. Or the 8-10 whatever percent of the REIT, but what if the real estate markets crash? What if there's bad tenants, the real estate properties, the underlying mechanisms go belly up? You lost that. You're being compensated for the risk that you're taking. And you might put it in the market, but if the markets go flat, then where are you going to take your income? You've got liquidity, so you could accentuate those losses. Maybe you put in some buffered ETFs. So the idea of the 4% rule isn't a hard, fast, you put your money into whatever you want and then hope it works out. And it's not that you can just take out 4% and you're stuck with that. It's a rule of thumb to let people know they might be getting closer to retirement. But the reality is, once you get close to it, you then start getting into the details of how are you diversifying your assets and your income strategies so that you know what to do when the markets go up and you've got what we call a bear market protocol. You know how to take income when the markets go down.
Mm-hmm.
So it works until it doesn't. Well, what's your strategy, your alternative strategy, your backup strategy for when it doesn't? You hold on to good REITs. Hopefully the income comes back. What do you do in the meantime? You're a dividend investor. Dividends dried up for a time being. What do you do until they come back? Markets go down. What do you do until they recover? Every strategy has a risk. What do you do until they recover? That part is it's not talked about nearly enough, except for the annuity people. And the annuity people say, you don't have to worry about the risk. Yeah, but you do need to worry about inflation and taxes because it's a slow risk. It's a subtle risk. It's the risk that slowly eats away at your retirement so that I think that if you assume a 3% inflation, you've lost 25% of your buying power. And after 20 years, it's like 43% of your buying power. Well, let's just do easy math. Today, let's assume that you've got 100,000 of income for easy math. Okay. Today, could you live off of 75,000? Well, no, that's kind of tight. Well, that's what it's going to feel like in 10 years if we assume 3% inflation.
Right.
Because it's a flat income stream. And there are other annuities out there and all of that have a cost of living adjustment. They have an index component to it. But even then, those components stop at a certain point.
Oh, during the length of the contract?
Yeah.
Okay.
So the moral of the story here is don't oversimplify your strategy. Have your backup strategy, your bear market protocol. Understand what to do when times are great, what to do when times are good, and what to do when times are bad. Have built-in flexibility with your plans. Don't fall for the oversimplified. It's just more dangerous than you realize. And that's just the income component. There are other parts, the taxes, the longevity risk. What was the question? I want to make sure we really hit this hard.
There are many strategies out there suggesting income around 8 to 9%. Why are advisors still talking about the 4%?
Yeah. If you feel like you're getting a good deal, it means you're taking on more risk. Learn what that risk is and what to do to compensate for the risk because it's not if, but when it doesn't work.